That's the button.
All right. All set.
Cool. So thanks for being here. I know it's obviously it's a commitment to leave your desk at 11 a.m. on a Wednesday morning to, listen to a random guy tell you about rules of the road, which will be the presentation I'll be taking you guys through. So you all know me, but just for the sake of it, my name is Mark and I'm a financial advisor with Edward Jones. And part of the reason why I love this job a lot is because I get to just educate people. I get to tell people about, this is what it looks like to be an efficient investor. And then by the end of that conversation, it's, you have the information, you have the education, now do with it as you wish. So that's what this is. So this is just going to be a education workshop where I take you through this presentation that we have at Edward Jones called Rules of the Road. And essentially it's a pathway of, this is where you're at right now. These are the rules of the road that hopefully by the end of it, you become an efficient investor, right? And then after that, we'll go through some Q&A. There's some stuff back here, so thank you, ladies. And then after that, we'll go through some Q&A, hopefully answer any questions that you may have. And then that'll be it. So hopefully I do it in a timely manner. And the rules of the road presentations are in there as well on the right hand side, I believe. But like I said, I became a financial advisor because I have a passion for investing, right? That's the thing that really that drove my decision to do this, as well as my passion for wanting to help people, and help people meet their financial goals specifically. So it's a big reason why I came into Present, like I said, is to help people become educated investors. So if we jump to slide 3, Nathan. So that we the cues. So we'll pop over to the 10 most important rules of the road. Like I said, this is just the presentation that's come about through the history of Edward Jones. Edward Jones, the company, has been around for 101 years. We just celebrated our 100th year a couple of years ago at this point, right? So over the past century or so, the company's really refined some of the tools and the strategies that they use to help their clients become more efficient investors. So if we move to slide 4, we're going to start the first rule, which is develop your strategy. So you guys have already heard me use that word strategy. What is a strategy, right? That's probably the first question that comes to your mind when you're thinking about investing. As far as strategy goes, some of the questions that you can think about is what's the most important thing to you? Is it your long-term goals? Is it thinking about retirement, right? Because we get to work for, let's say, 35 years, right? Maybe 40. And after that point, hopefully, if you're like me, you want to be done, right? You want to financially retire, the word that we throw around, where because of the past 30 years, you worked really hard, right? And you want the next decades of your life to be relaxing. You don't want to feel like you have to work a 40, 50-hour job to be able to survive, to be able to enjoy those later decades in life. So what's the strategy you have in place to reach those long-term goals? What's the length of time that you have to invest? If you're starting in your 20s, is it 40 years? If you're starting in your 30s and 40s and so on and so forth. What's your comfort with risk when you think about the investments that you want to put your money towards? We'll talk about that here in a second as well. And what are the required steps that you need to take to get there? So, part of the process that I would take a client through is write down your strategy, right? Because once you write it down, there's this sense of owning it, right? You own your strategy. This is what I've said I'm going to do for however many years between now and then, so that I can reach that goal. This is what's going to keep me accountable. And as their financial advisor, right, then it's my job to keep them accountable at that point. So that's what this first step is. This first rule is just speaking a lot to what's your strategy as an individual? What do you want to accomplish and how do we get there? And once again, that's why it's highly important to talk to a professional in the field who can keep you accountable, because just like just like we use other professionals in the world, right? We use professionals to keep us accountable to our health, right? When we go to those annual visits, I hope you guys go to your annual visits, right? Your doctor keeps you accountable to the health goals that you place for yourself. That's just one example. Another professional keeps you accountable to something else. Financial advisors do the exact same thing. So if you move to the next slide, Aidan, there we go, some examples here, right? Benefits of working with an advisor include those three. Being able to outline and prioritize your own goals, being able to instill that discipline, right, within you to make sure that those goals are being reached, and being able to provide guidance as time goes on, and periodically revisit your goals to help you keep on track. Honestly, so I coach, so I'm a part-time coach as well at CHP on the men's soccer team, as well as I get to coach some of the youth, kind of high school kids during the summers and winters as well. And the thing that I love the most about this job is that there's a certain part of coaching that comes towards it, right? Being able to hold people accountable to what they say they want to reach, right? Obviously, as a coach, it's a little bit of a shorter timeline, 4 years high school, 4 years college, and that's it. But the good thing with being an advisor is that I hopefully have you guys for the rest of your life. Right, I have you over the span of decades to come to make sure that we're reaching those goals that we talked about and developing those strategies. So let's move on to the next slide, which should be rule number 2, which talks about understanding risk. You have most likely heard of the term risk versus reward, right? And risk and return, they generally go hand in hand. So the more risky you are, the odds of the return being higher are greater. So being able to understand that risk and vice versa, right? The less risky you are, even when it comes to the markets, right? The less likely you are to expose yourself to those higher returns. And my job is to tell you that it's absolutely okay, regardless of where you end up on that timeline, right? From being completely risk averse to wanting to jump over a cliff and knowing someone's going to catch you, right? In regards to your investments, it's absolutely okay with wherever you line up on that timeline. But what you should do is recognize where you are on that timeline, right? And invest accordingly to where you are on that timeline. And don't be put in a place as an investor where you are, say, let's do a little bit more risk averse, right? Don't be put in a place where the investments that your money is going towards, that you could wake up tomorrow and you're down 20%, and then you have a heart attack, and then you're like, oh snap, I need to pull out, right? Don't be put in a place where your investments are in that situation, because then you start to lose out on those gains, right? Rule number 2 is being able to understand where you lie in regards to your risk. Some of the questions that you could ask yourself to help answer where you do lie is, what is your comfort level of risk? How much risk are you able to take? And how much risk do you need to take, right? So risk is also somewhat connected to age, for example, right? So the younger you are, the more risky you can be, because there's more time on your side for markets to rebound. So what I mean by that is, if you are in your 20s or 30s, you have a bigger chunk of time to be risky because the market's already rebound. There's been about 12 to 14 down years in the past 100 years since the stock market opened, right? That tells me, as an investor, is that, hey, we're going to have down markets, but B, we're going to have way more up markets than down markets. So being able to understand that, being able to understand where you are age-wise, right, helps you take advantage of that. Because if you are in your 70s, I'm not going to encourage you to be risky, right? Because you have less time. So that wouldn't be being an efficient investor, right? For that person in the 70s and so on and so forth. But someone in the 20s and 30s, absolutely, let's go. let's put you in the market so that you can allow yourself to receive those greater returns, right? Rule number 3, if you will, Aidan. So this is slide 7. This is diversifying for a solid foundation. Aidan asked me whether we're going to talk about diversification, and we definitely are. So what diversification is, it's just a fancy word, right? It essentially means don't put all your eggs in one basket, right? So when you're thinking about yourself as an efficient investor, asset allocation is a really important topic to think about, right? It's this idea of a diversified mix of stocks, bonds, cash, right? International stocks as well, and other investments in asset classes, to make sure that you are not fully susceptible to the effects of one of those sectors, right? So what I mean by that is if you put all your money in Apple today, right? Let's say you have, $50,000 in Apple because you love their devices and every single thing you own is Apple. You have the iPhone, you have the MacBook, you have the iPad, you have the Apple Watch, right? You have everything. But then you wake up tomorrow and Apple tanks, right? How would that make you feel as an investor? I'll panic, right? If I wake up tomorrow and my $50,000 in Apple is going down, and that's the only $50,000 I have working for me, and it's down $20,000, I'm going to be pretty depressed, right? So what diversification adds to that equation is, hey, guess what? It's okay to have some in Apple, but let's diversify more so that you're not as susceptible to the failing, the potential failings of Apple, because they are. There's failings every single time you put your money in the market, right? But let's diversify a little bit more. Hey, let's look at mutual fund. Let's look at ETF, right? Those are just collections of stocks within that, right? So let's look at a mutual fund that has a high percentage of Apple, but then it also has 100 different companies in there. That way, if Apple doesn't do good, guess what? Nike, Adidas, Tesla, right? All of these other companies are going to hold that mutual fund up. That way, if Apple fails, you're also doing okay. So when it comes to diversification, it's always good to start with a mix of stocks and bonds. And stock prices tend to fluctuate over time, right? That's where most of your growth is going to come from. And they historically provide high returns, whereas bonds tend to fluctuate a little bit less. But they typically provide lower returns, but they balance out the high fluctuations that stocks give. So your general mix of stocks and bonds will help determine what your portfolio return is going to be over time. Right, for example, and there's other things, like I said, like international stocks, there's correlations that go into there as well. But international stocks, for example, will not always move in the same direction as domestic stocks, right? So we take that into consideration when we're building up an efficient portfolio for our investors. Okay. So I think I've killed diversification. Let's move on to rule number 4, which is stick with quality. And sticking with quality, this is a lot closer to Edward Jones just because of the company. We don't want to encourage our investors to put their hard-earned money towards things that they don't know, or towards things that haven't been vetted by a group of people in our home office to make sure that you are getting the most quality investment suggestions for you to say yes or no to those clients. Because for some investments, there's an easy way to measure quality, right? But for most, it takes some work, and the work is done by Edward Jones to make sure that whatever you get in front of you as investors to say yes or no to has been vetted. So, for example, bonds, one measure of quality is this aspect of investment grade, right? So investment grade and credit rating, which indicates to the borrower, that's what a bond is, right? So as an investor, I'm given $10,000 to the state of Colorado, right, to build a bridge in Denver, and that's what my bond is tied to, right? So one measure for a bond, for example, that indicates to the borrower, indicates to you, the investor, the borrower has a good track record, is making the promised interest and principal payments on time, right? So quality always means that these investments are more likely to overcome temporary challenges, which is why a good track record can be an indication of quality. So once again, if you're looking at Apple, they've been around for a while, track record is good. They most likely have an indicator of buy this and trust this, right? And just like methodology wise with Edward Jones, and I mean, this speaks to myself as an advisor as well, is that we don't go towards risky investments, so we don't do day trading. And we don't invest in things like, say, cryptocurrency, which right now is obviously, there's been some good things that have come from both of those, but because of how volatile the two are, it's really hard for us to encourage our investors to put their hard-earned money towards that, just because, once again, they're really risky, right? There's not that much time behind things like cryptocurrency to tell us that they are quality investments, at least for us at Edward Jones, right? So that's just an example of what we mean by stick with quality. If we move to the next rule, Rule 5 is invest for the long term. It's very self-explanatory, but I'm sure you've heard of this concept that it's time in the market, not time in the market, right? So time in the market is your best friend. So if you have decades to go, that is really your best friend. The fact that you have so much time in your hand, you have so much time in your life to see your investments grow, is really the number one variable that will put you in a great place as an investor. The second point is buy and hold doesn't mean buy and forget, right? I'm sure I've had this over the past few years that I just want to buy something and don't touch it, right? That's better than buying and selling the next day, in my opinion, but it's not as good as check on your investments, right? Especially if you're paying an investment company to do this for you, right? Call in, ask, hey, what's going on? At Edward Jones, we have annual reviews with our clients to make sure that at least every year, you know what's going on in your account, and 6-month check-ins as well. You should know what's going on in your account as you invest for the long term, right? Like I said, one of the biggest mistakes that investors try to do is time the markets, and this may involve moving money in and out periodically and sporadically in response to short-term declines or the latest prediction. And a recent example of that is what year are we in? 2024. So 2022 was a terrible year. So I think we closed at about minus 25%, right? S&P 500. So it was a terrible year for us. We're rebounding off COVID. Russia and Ukraine is happening, right? So there was a lot of instability in the stock market. And what you tend to see is you end up seeing investors who see that and want to pull out, right? They want to pull out. You're already down minus 25%, but you want to pull out. And what we say once again is how many up markets have we seen versus down markets? It's literally exponentially different. Stay in and wait, right? And then what do we see in 2023? It's up by 30-something% by the end of the year, right? So time in the market is what matters, not time in the market. That's just a more recent example of what happens in that. So as we invest for the long term, that's what matters. So let's move on to slide 10. The rule 6, I think slide 10. Sorry. Have realistic expectations in regards to your strategy, right? What return do I need, as well as how do I achieve my expectations, right? By realistic, I mean a portfolio of about $50,000 is not going to become $1 million in 5 years, right? That's the realistic expectation of, let's use the algorithms, right? Let's use the algorithms that help point us towards this is what I need to be doing right now to make sure down the line I reach that number, I reach that goal. Have realistic expectations put in place. Because your expectations about how your investments will perform can have a very big effect on your strategy, right? So if you have a long-term strategy, your expectations have to be in unison with that long-term strategy, and so on and so forth. Right, to set the right expectations, you first need to determine the return you're trying to achieve. This should be the return you need to reach your goals, so just like we said. Right, and the whole point of having a company like Edward Jones and myself as a financial advisor is being able to review your performance, being able to review what those expectations are in context of those long-term goals. And it's my job to say, I think we can reach these, right? And we can do that together. Or doesn't look like we're going to reach these. This is what we need to do to change that, right? Do we need to change the end goal, or do we need to change the in-between? So after you set your expectations, the next step is to work and achieve them. So let's go to rule 7. This is maintaining your balance. Maintaining your balance. Maintaining your balance is this concept that there's much more that affects you as an investor, right? So you are earning money at work, you're putting it into your 401k, or you're contributing to an IRA outside of that. That's great, but there's other variables that can affect you as an investor, right? So being able to strive to balance work with play, right? So we all have 40-hour weeks, 50, 60 maybe. I don't know how crazy employees you guys are sometimes, but I have those long weeks sometimes, right? But how do you balance work with play? We know that there's an importance towards things like exercising, right? Balanced diets, being able to spend time with friends and family. The same thing works with your investments, right? That's why working together to review your investment mix on a regular basis is so important, because we require balance in every single area of our life, right? To make sure we're as healthy as we can be in those areas. It's the same thing with your financial strategy. And being able to focus on the things we just talked about, like asset allocation, diversification, and all of that fun stuff. And this is designed to align with your comfort level of risk and position you to achieve those long-term financial goals. So just as everything else in life needs balance for it to be healthy, and if there is no balance, then it's most likely very unhealthy, right? Your financial goals are the same thing. Being able to have a portfolio that's balanced, being able to allocate some time, in your, I would say right, in your year to year, kind of checking in on your portfolio matters, because in the long run, that's how you achieve those goals. And it also helps take the emotions out of your investing decisions, right? So if you're able to, like I said, for example, you're going away with this, hopefully with one thing, right? What's the thing that matters in the market? Time in the market versus time in the market, right? So if you spend time understanding that concept, that's going to help you not be emotional as you make your investing decisions, right? And being able to maintain the balance of your life is critical to being able to understand those. Okay. So let's discuss prepare for the unexpected. I think I'm doing good on time. It's good. Every single time I talk, I sometimes over talk, so I'm being overly, I'm assessing myself too much right now. I have like actual minutes written on all the rules that I need to spend to talk about them. But anyways, rule 8 is prepare for the unexpected. So being able to establish a proper foundation and address risks as they come throughout your life. And the reason it's unexpected is because it's unexpected, right? But to the best of our ability, we can prepare for that. Things like, do you have an emergency fund for when that water heater goes off in the house? Or when, you have a pet and the pet just destroys the whole carpet and you need to change the carpet, right? Or you have a young toddler who just breaks everything that is in their path, right? You have an emergency fund to take care of the things that pop up in life that they're just unexpected. Is insurance an aspect in your financial plan, right? You have some type of insurance plan that would help take care of your loved ones if something was to happen to you, especially if you have dependents, right? Do you have an estate plan? Do you have a plan that outlines, whenever that time comes, so it comes to all of us, right? Whenever that time comes, you have an estate plan that helps outline, hey, your loved ones are left behind, they're mourning, right? They just lost someone that they love. Do you have a plan that helps allocate whatever you have to avoid fighting, quarrels, family breakups, right? I'm telling you that because there's a lot of estate plans, right, that I get to work with, and all of that happens just because there's a lack of clarity. So have you prepared for the unexpected? I wouldn't say retirement is unexpected because we're all going to do that. We all know that our bodies are going to run out of steam at some point. So I wouldn't include that in the unexpected, but some of those other things I definitely would. Regardless of where you are in life, we recommend certain strategies to help you and your family prepare for the unexpected. Like I said, emergency fund, just because everyone needs them. Think about your insurance options. And being able to plan for your estate. I think that's on the next slide. Yeah, there you go. So rule number 9, focus on what you can control. And to me, this is retirement, right? A big part of that is retirement and just, general day investing. Because it's existed for so long, over a century, like I said. There are some time tested principles and they're not predictions that will push investors towards the right direction into making healthy decisions. So when investing, there are some things that you can't control, right? For instance, you can't influence the day-to-day fluctuations in the market. You can't influence whether Apple goes down tomorrow. Can't influence whether Tesla goes down tomorrow, right? Or the economy or the political environment. But the good news is that you don't have to, right? You don't. You have to worry about your day-to-day life. That's hustle enough. But too often investors can become distracted by the latest headline or the expert prediction. But these are the things that we believe in at Edward Jones that are keys to the success in the midst of ignoring these predictions, right? So instead, base your decisions on time-tested principles like diversifying your portfolio, right? That's going to take care of a lot, right? Things like election years, things like wars breaking out in the world, diversifying your portfolio is going to protect you against a lot of that. It's not going to guarantee returns. It's not going to guarantee any market downturns, but it is going to help. It is going to help steady the crazy in the world, right? The second thing is it on the next slide? No, never mind, go back, sorry. Is owning quality investments. So investments that are deemed quality through those different rigorous investment grade testings that we would use, and not just us, but the whole financial world, and maintaining a long-term perspective. So those would be the three main time-tested investment principles that we use at Edward Jones: diversifying your portfolio, owning quality investments, and maintaining a long-term perspective. Because what often prevents investors from reaching their goals is not market fluctuations, but it's actually their reaction to the fluctuations, right? Because it's going to go up and down. We just established that, right? But it's how as investors do you react to that? Because people tend to buy in the market when things are good, right? Apple's doing great right now. I'm going to spend $200 per share, right? Because it's doing great, rather than, oh, actually, Apple is not doing great right now. Maybe this is a discount opportunity, right? So we tend to buy when the markets are up and they feel good, and to sell when things are declining, right? So you buy Apple at 200, when Apple gets to 160, then it's like, oh, I need to sell, but that's $40, right? Well, that's $40 that you just lost. So yeah, buying high, selling low, not good. It's no surprise, but this is why you need a long-term strategy in place. The key is to not let your emotions control your investment decisions. Focus on what you can control. You can control your emotions, guys. But you can't control the politics, right? You can't control the economic structure. You can't control the wars that happen. You can't control those things. But there are a few things you can control. So let's do a good job at doing that. So the 10th and final rule is reviewing your strategy regularly. Anyways. Can't speak. The one constant you can expect is change, right? Whether that's just you as a human being, right? Next year, you're going to be a year older than you are this year. How does that play with what's going on in your portfolio? Your goals will change over time. Your life will change over time. Whether it's a new job, whether it's an addition to a family, whether it's retirement is 10 years closer than it was 10 years ago. And your strategy needs to adapt, right? It needs to adapt to the things that happen in our lives. And this is where the review becomes so important. So like I said, you have periodic checkups with Edward Jones, with financial advisors like myself. And developing your strategy is only the beginning, right? Because the role of the financial advisor is to make sure that strategy is being reviewed and that regular checkup is happening, right? Like I said, did your family grow today? Are you looking at buying a house? Are you, did you gain a grandchild? Do you want to send someone to college, right? All of those things are questions that we get to ask in a periodic checkups to make sure that we are still staying the course for the long-term goal, right? 20 years in the future. But guess what? There's short-term goals that can come up in the midst of that. If you want to buy a house in 5 years, let's figure out a way that we can get you a house in 5 years, and so on and so forth, right? Okay. Stay on course, more than just your investments, your periodic checkup. Oh yeah, actually, I forgot about that. That's probably the favorite part of my job. It's, the relationship that I have as an advisor with my clients is more than just investments, right? It's the relationship, right? Part of the reason why actually this is me to you guys, part of the reason why I wanted to stay in Pueblo is because of that. There's this real sense of if you're doing business with someone, it's not just business, right? There's a real relationship behind, I suppose, the transaction that's happening in that instance, right? And part of the reason why I love being an advisor is because it's more than just me making sure that your portfolios are squeaky clean. But it's more than that. It's about me and my client and me making sure that for as long as I get to serve them in this role, I'm taking care of them. The really important thing we just talked about. So, quick recap. So rule 1 is develop your strategy. Big recommendation is having a documented risk and investment strategy that meets those tailored goals. Rule 2 is understanding risk and seeing what the kind of correlation is between risk and reaching those long-term goals. Being able to understand your comfort level with risk and how much risk you're willing to take to reach those goals. Rule 3 is being able to diversify for a solid foundation. Diversification does not ensure profit, like I said, but what it does do is help provide a smoother ride over time by reducing the swings in value. Rule 4 is being able to stick with quality. For stocks, focus on the steadiness of the earnings and dividend growth over time, like Apple, like I said, right? And then for bonds, it's being able to have a measure of quality and a good track record that they're making the interest and promise payments to the people who entrust them with their hard-earned money. Rule 5 is being able to invest for the long term, and realizing that come what may, I'm in this, we're going to be fine. Market's going to come back up, and if needed, we can make some necessary changes, but only if needed. But understanding that rule 1, if you do rule 1 really well, rule 5 makes sense, right? So if you have a good strategy developed, then investing for the long term becomes easier, right? Having realistic expectations is rule 6, and being able to accurately track your progress and ultimately achieve those long-term goals. Rule 7 is maintaining your balance. Like I said, everything in life has balance in order for it to be healthy. The same thing speaks about your financial goals and being able to stay on track for them. Rule 8 is being able to prepare for the unexpected. Can't predict the future, but you can prepare for the unexpected. How you address the unexpected will evolve over time as your goals change as well. Rule 9 is focused on what you can control. I think kind of hit the nail on its head there. You can't control everything, right? But you can control certain things. And being able to do that would help you keep on track with that strategy. And finally, number 10 is being able to review your strategy regularly to make sure that you know what's going on in your accounts. And if changes need to be made, they happen. And being able to compare the movement of your strategy with things that happen in life, like I said, that's really challenging. All right, that's that presentation done. I think it's Q&A time right now. There we go. So Q&A. Thanks for listening to me babble on for about half an hour. I know that it's a mouthful, but if you guys have any questions, I'd love to hear them and I'll see what I could answer them. And if not, I'll be able to in a day's time.
I have a question on, when you were talking about estate planning, is that something you do like as a one-off service, or is that something that they have to have other services with you to have estate planning included?
Yeah, that makes sense. That's a good question. I would say it's a service that normally comes as a result of having accounts. Because that helps us estate plan, to the most efficient degree that we can. Is being able to understand what you all have in life, what you've built up in life, and that helps us understand things like, okay, this is what you want to give to this beneficiary, this is what you want to give to that beneficiary, and so on and so forth. And the other thing with estate planning is that we get to work with the lawyers and attorneys in town, which is actually really helpful and really cool, just because there's advice that I can't give because I'm not a lawyer. And there's things that a lawyer can't give because they're not a financial advisor, but being able to partner with other professionals for the sake of the client is hopefully what gets us to that goal of efficient and healthy estate planning. So, yeah, so to answer your question, I think it normally happens with clients who do have accounts with us, just because it gives me the fuller picture of this is what is in the best interest because I know what's going on.
Okay.
Question mark. Where might your office be located?
The business part, it's literally down the road, 200 West City Center, intersection bank building.
We're neighbors.
Yeah.
We have coffee every morning.
A little collaboration again, thank
Yes.
you.
Oh, did someone ask that on Zoom?
No, that helped with the recording.
Oh. Everything makes sense.
I say so, yeah.
Okay, so if no one else has any questions, feel free to ask any, if you have my card, feel free to reach out whenever you need to. That just reminded me. So within your little packets, there's some other sheets of paper in there. So you have the main rules of the road presentation. We also have the investments in services that we offer Everjoints, which is really a holistic picture of essentially being a financial advisor, right? So we have all the different types of retirement accounts, but you could think of business owners as well. We have plans for business owners in regards to retirement accounts, SEPs, Simples, 401ks, so on and so forth. Then at the back, you have the different investments that we use your money to invest in those retirement accounts or brokerage accounts, stocks, bonds, mutual funds, ETFs, UITs. We also have insurance policies, life insurance, long-term care, and long-term disability, which are completely separate from one another. Joey asked that question earlier on. So they're not riders of each other, but they're actual separate policies if needed for the client. We have annuities as well as cash and credit options as well. No more questions? Okay.
Thank you, Mark.
Less than 4 minutes. I'll take them.
Oh, thank you very much.
Less than 40 minutes.
I'm an elephant, I never forget. I never forget.
Everything at the base.
It's good.
Yeah.
It's going.